essentially talking about what's the economy look like going into the coming year. And I'd like to report that it's looking positive. It's looking good. It's looking as though that kind of economic soft landing that the Federal Reserve Bank is trying to achieve, I think they're going to hit it, okay? But what I want to do is kind of give you an overview of some of the things that's happening. This is a simple indicator of what's happening to gross domestic product at the state level, Wisconsin, which is the red line, the United States and the Great Lakes. And you can see the impacts of COVID. You can see that Wisconsin recovered fairly quickly, but has been kind of flat. But you can also see the upticks in the most recent data. So, I mean, from a larger perspective, the U.S. economy has actually recovered quite nicely. Wisconsin's lagging behind just a little bit, and we'll get into why I think that might be. Okay, if we look at employment, you can again see that the U.S. employment rate is growing a little bit faster than Wisconsin and the Great Lakes, but we're right on par with what a lot of our neighboring states are doing. So is it that Wisconsin is kind of lagging behind, or is this more of a Midwest Great Lakes type phenomenon? I think we have to consider what's happening to the neighbors around us. If you look at the unemployment rate, however, Wisconsin's unemployment rate is pretty low. Wisconsin's unemployment rate has historically been one of the lowest unemployment rates around the Midwest. Wisconsinites like to work. Our labor force participation rate is one of the highest in the country. We like to work. But if you look at that unemployment rate, that kind of points to kind of the labor force issue that we're having now. As I work with rural communities across Wisconsin, there's a number of issues that almost every community is struggling with, and availability of labor is one of them. And that is also something that the agricultural industry is facing very heavily. And I think one of the things that we can look at is kind of the demand for labor and the supply of labor. What this is we're looking at the number of job openings, which is the kind of the darker line, and the number of unemployed. So the job openings is kind of the demand for labor, and the unemployed is kind of the supply of labor that's available. And you'll notice that up until about 2015, the number of unemployed people were greater than the number of job openings. So there was a bit of a surplus of labor. But after that time period, that flipped. We had more job openings than we had people available in the labor force to take those jobs. There was a labor shortage, and then COVID hit. And then we recovered. Now, what's unique about what's the recovery is that we're seeing a lot more job openings now than we are people that are looking for work. That's the labor shortage. Now, the thing is, a lot of people think that this might be because of the effects of COVID. This is something that we were facing before COVID. COVID has just kind of put a spotlight on it because people are kind of rethinking work and nature of work, remote work, hybrid work, things like that. So this is not a unique phenomenon. Now, the most recent data, and I don't have this for the state of Wisconsin, Wisconsin hasn't posted it yet, but there's been 1 month for the US, and it looks as though this is starting to slow down a little bit. The number of job openings is declining just a little bit. It's not gone negative, but it's not quite as rapid. And the number of unemployed is ticked up ever so slightly. So that gap is getting a little bit smaller, okay? Now, what about economic forecasts? This is something that all economists like to pretend that we're economic forecasters. I mean, that's kind of the thing that we all kind of think that, yes, we do economic forecasting ourselves. I kind of rely on people that spend a lot of time doing this. Now, if all of you were economists and all you did was economic forecasting, right? Go with me. Maybe you need some more coffee while you think this through. But if I were to grab any one of you at random and ask you what your economic forecast was, you'd probably be wrong. Well, what the research suggests is that if I took an average of all of you, that average is probably going to be pretty accurate. All right? So one of the things that the Wall Street Journal does is they do a quarterly survey of about 70 different economic forecasters. And they make this available. And what I want to do is I want to use that information to kind of look at what the current thinking is in terms of economic forecasts. Okay? They do it quarterly. The most recent one was put out on January 14th, Sunday morning at 5 o'clock in the morning. I don't know why they would do Sunday morning at 5 o'clock in the morning, but that's when they posted it. So guess what I was doing that Sunday morning? This is a listing of all the various it goes from academics to banks to insurance companies. There's a lot of folks that spent a lot of time on this. Now, what I did is I essentially took an average, and then I computed the standard deviation, and I added the standard deviation, and I subtracted the standard deviation to kind of give you an idea of the range. This is the economic forecast for GDP over the next coming year. You can see the center dot there, that's the average. The height of the bar, the bottom of the bar is kind of that range. The tighter that is, the greater the confidence is that we have, the greater the degree of agreement there is. The farther that bar, there's more disagreement. What I like here is that there's other than that second quarter 2024, there's some economists that think we're going to go into a mild dip down, negative growth. But the overall average is that we're going to go into a slowdown, but a soft landing. We're not going to go into an economic recession. That magical soft landing, it looks like we might be hitting it. Okay. Now, this is a radical change because all of these forecasts over the past year, they've all been forecasting, we're going to hit a recession. We're going to hit a recession. The question was, how deep of a recession? Is it going to be a mild recession? Is it going to be a deep recession? Folks have changed their minds. We're going to hit a soft landing now. Okay. Now, if we look at this forecast longer out, gross domestic product will go out to 2026. You can see the 2024, the forecast is we're going to see a little bit of a dip down. We're not going to go into a recession. We're going to dip down, and then we're going to bounce right back up to about a 2% annual growth rate, which is about average for the US. That's what we would expect. Okay. Now, what about the unemployment rate? The unemployment rate is going to tick up. But from a historical perspective, these are very low unemployment rates. If you look at Wisconsin's average unemployment rate going back to 1976, it's about 5.3%. We're not going to be anywhere near that. Okay, so we're going to see a tick up in unemployment, but it's going to be a modest tick up. And then it's going to come right back down again. Okay? The unemployment rate going farther out in the future, same thing. We're going to be at around 4%, which is a pretty reasonable unemployment rate. Okay? Essentially, that tight labor market is going to start to loosen up a little bit. Now, what about consumer price index? This is what triggered the Fed to start raising interest rates, to get inflation under control. Okay, and the one measure that we tend to use a lot is consumer price index. That's the one that's oftentimes, you hear about like Social Security benefits, there's a cost of living adjustment, they use the consumer price index. When they adjust federal income tax, those income categories for taxes, they adjust them a little bit every year. They use the consumer price index for that, okay? Now, what the forecast is are we going to hit 2%? That's the magic goal of the Fed. Probably not, but we're going to get really, really close to it, okay? So the idea here is the forecast is we're going to go down. Now, the Fed actually prefers a different consumer price index. They prefer the personal consumption expenditure price index. And now this is where economists can kind of, what's the right word? We debate about which is the best measure. Okay? Well, the Fed thinks this is a better measure. They're the ones calling the shots, so let's look at this one. Same thing, okay? The inflation rate is going to be coming down, all right, across the board. And we can talk about this later if you want to know the differences between these things, okay? Now, what about interest rates? Notice that this is really clear. The interest rates, this is the 10-year Treasury notes. The forecasted interest rate is going to be about 3.7% going out. Notice that as you go farther out in time, that those bands get bigger. That's because as you go farther out into time, there's more noise, there's more uncertainty, more things can happen, like the Middle East. Or God forbid something happens with Taiwan. Okay, things happen that we cannot forecast. This is the midpoint of the federal funds rate. This is the key interest rate the Federal Reserve Bank is adjusting. What we're trying to do here is, we're not me, these economists are trying to do is forecast federal policy, okay? Now, what this is that banks, by law, have to have a certain amount of cash on hand at the end of the day, okay? It's regulations that came out of the Great Depression. Okay? At the end of the business day, some banks have more cash than they need. Other banks are coming up short. Well, what they do is they lend money back and forth to each other. The interest rate that's set is this interest rate. This is set by policy. Okay. The idea here is that we're going to start to see that interest rates start to come down and probably level out at around 3%, which is kind of a historical average. Now, one of the things that the Wall Street Journal did is they asked, when do you think the Federal Reserve is going to stop dropping interest rates? They're thinking pretty soon. Okay, there's some argument. Any of you watch the stock market? The stock market yesterday set new highs. There's an argument that the stock market is essentially saying the Fed is going to start dropping interest rates, and they're going to start dropping them soon. These economists are essentially saying that probably by early summer, they're going to start dropping interest rates. I think that's a bit optimistic. Okay? But this forecast is there's going to be relief coming shortly, is helping to build up the stock market. Okay, now one of the questions is, what's the probability of a recession within the next 12 months? And the average here, you can see there's one person that said it's about a 2%. There's a couple of people up there who say it's about an 80% average, okay? Have you heard the phrase, you put 10 economists in the room, you ask them a question, you get 12 different answers? There you go, okay? The average is 39%, the median is about 40%. So there is a probability that we might go into a recession. It's less than 50%. The reason we might go into a recession is stuff happens. Okay, look what's happening in the Middle East right now. Okay, there could be shocks that could derail the economy. Okay, and I will stop there, and I think I'm within time. But the economy looks like we're going to a soft landing. It looks like, if you look at the glass looks like it's half full. Okay, that doesn't mean that stuff can't derail the economy, but it looks like we're going in the right direction. Thank you.